We asked a couple questions, anything that you guys want to learn about, and we will answer them in a video and audio format as a short form episode that we're going to be doing, answering some of you guys' questions here that you guys have emailed us. I'd love to hear how you guys raise debt versus how you raise equity on a deal, and how a deal would go full cycle and all the details in between. You can ask them for what's called a debt raise or an equity raise.
So if you're going to give up equity in the deal, typically you're going to have a percentage or a pref that they'll call it, a preferred return, and that's paid however you decide to set that up, and that'll be substantially lower than just a cash on cash return. But if you're giving away equity, now they're going to get a percentage of the deal that's paid out however you structure that deal.
So there's two different types of people that you can go after. You can go after people that are looking to grow their net worth, or you're looking for people who are looking for cash flow.
Yeah, the other thing is it's really figuring out who you want to talk to, and it's just going to take time and repetition and finding the right groups that have the audience that you're in.
Welcome to The Big Break Show, your go-to podcast for real estate investing, business acquisition, mindset, and lifestyle. Now, let's dive into Season 2 with your hosts, Rafa and Dan Tollens.
What's up, everybody? Welcome to another episode of The Big Break Show, and I'm here with Dan Tollens.
Yes, sir.
What's up, brother?
Get it done.
Yeah, man. So we're hanging out. We got a special episode for you guys today. I know we've been doing a lot of interviews, and the point of the podcast, as I've always said, and is to help you guys learn, to teach to you guys things that we've been going through, for you guys to kind of get some free knowledge, good knowledge in the world of the internet, where there's just a bunch of stuff out there. We're trying to give you guys our experience in video and audio format so you guys can pick some stuff up. So the first couple episodes that Dan and I did, we asked a couple questions, and we said, hey, if you guys have anything that you guys want to learn about or you guys want to know about, shoot us an email, and we will answer them in a video and audio format as a short form episode. So this is going to be a short form episode that we're going to be doing, answering some of you guys' questions here that you guys have emailed us. You want to tell everybody where we're at?
Yeah, we're here at one of our homes that we just got kind of halfway through renovating here in Carolina Beach. You can see great, beautiful background here. We live on a canal, so we got deep water here. It leads out to the Intercoastal Waterway. So pretty cool setup, and excited to be back on the island and spend some time with you guys.
I know, this is great, man. I'm super pumped. So obviously we're smoking cigars. So guys, grab a drink, grab a cigar, listen to this while you're at the gym, whatever you want. But buckle up. We got a good episode for you guys today. And thank God the weather looks good.
The other thing you didn't really touch on was that, we've had, an abundance of guests, probably a dozen or more. Mm-hmm. And I think it's important for us to, as we kind of go through this, is then circle back and have, just stuff of you and I talking about, what we've learned off of those other people, but also, what do we got going on in our world? We're working through some hotel deals and some other hospitality deals, as well as arbitrage deals and new construction and building new relationships. And I think it's important to kind of talk about all those things and some other masterminds or other events that we've been to, and take, some takeaways from that.
I think it's a great way to take the podcast in a direction where we can actually reflect on what we've talked about and have learned and have done. Because otherwise we're just recording and moving on. It's like going to a mastermind and not picking up anything that you've learned, right? The whole reason why I like doing these interviews is to learn from the people that come on and ask actual questions to not only make us better, but make the audience better, and do it in this format so that everybody can benefit from it. So yeah, great point, dude. All right, so we had a question, and this isn't structured, guys, just so you guys know. We're going to just kind of talk about our experience of how we've done things, and we're going to try to keep them short, 5, 10, 15, maybe even 30 minutes, depending on how in-depth the conversation gets. But in this case, we had somebody saying, I'd love to hear how you guys raise debt versus how you raise equity on a deal, and how a deal would go full cycle and all the details in between. So I thought this would be a great episode to talk about, because there's so many different ways that you can structure a deal. Now, for those of you that don't have any background in this type of question or what they're talking about, we're going to make the assumption that they're talking about doing a syndication or raising capital to do a syndication, and not necessarily a syndication, but to do a deal, because usually when you're raising to do a deal, in a syndication, you offer equity and you offer debt. Or if you're going to bring in a partner, instead of doing a JV deal, you're just raising money from investors. So to give you an overview, let's just say we're going to go buy a boutique hotel, since we're both in the boutique hotel space now. You go and pick up a 14 unit, 20 unit, whatever the case may be, and it's worth $5 million. And you can structure it in two ways. If you want to raise the down payment and the capital expenditures, the rehab, everything that's needed for all that, and you don't want to come any money out of pocket, you can go into your network, people that know, like, and trust you, and you can ask them for what's called a debt raise or an equity raise. You want to touch on that? I don't think they can hear him all the way over here. It'd be fine. I think the mic's
Yeah, so I would like to go pick up my neighbor's dog and put him in the house. But no, kind of touching base on the two styles of raises. This question, like you said, may have been related to any type of thing, but what we're in the middle of doing or have done, have experience in doing is raising for boutique hotels. Like we've done is that we typically have not really raised from folks outside of our immediate network of family and friends. And so over this last couple of deals, that was what we had started doing was, reaching out to folks and said, hey, listen, like, here's what we have and here's what the underwriting looks like. And then it has a certain amount of cash flow, right? The whole reason we're doing these deals together is it has so much cash flow. And so we want to try to keep as much equity, obviously, as we can. But in some efforts, that's obviously not what you're able to do. So overall, I would say you just have to figure out what is the best strategy for that deal, right? For example, we have a deal where we've raised, we actually have a seller finance deal where they're going to give us 5 years of seller finance, first year no payment, the other 4 years interest only at 3%. So you're not going to be able to go get that at current market at the bank. So if we were to go do an SBA loan, which is an option, the interest rate's probably going to be somewhere, 7.5, 8.5, 11, whatever the case may be. And they might give us anywhere from 90 to 75% of the deal. So we do have that delta somewhere between 10 and 25. So that would be what we would try to raise if we're not trying to use our own capital, right?
Correct.
And so then what you do is you kind of back into that number and you say, all right, here's what are the values on finding the deal? What's the values on the structure of the deal? What's the value on the financing of the deal? And then what's the value of, if you're going to bring in, maybe an outside equity firm or an outside business partner to do the raise for you? How much of that is that worth? Is that worth, percentage in the deal or an actual fee or a combination of both?
Correct. Let's put numbers to here so that we could get a clear example, because a lot of things that you said is the SBA loan part where we can raise the money from an SBA loan, and that's a government loan for those of you that don't know, but they don't fund the entire deal. So let's just give numbers here. $1 million deal, SBA would give you 80%.
Well, sort of, right? So that's why banks love SBA loans, and I've learned this just through our business partner being a banker. He's kind of helped educate me on what you don't normally hear other than just go get an SBA loan. So why banks like SBA loans is the bank will do 50% of the whatever the request is, right? So if you're buying $1 million, the bank's going to give you $500,000, and then SBA is going to come in, which that's an insured loan. So the bank is not on the hook for the other portion of the loan, whether that's 25, 30%, 40%, whatever it is. And so that's kind of where the risk mitigation comes into play, and then all the different hurdles you got to go through with SBA.
Okay, so before we get into the SBA thing, back to the numbers thing. So let's just say they're going to fund a percentage. What's the percentage, or what's the number that you're raising for?
So, our particular deal,
$1 million.
Right.
Let's stick to the $1 million.
So let's say you got $1 million deal.
Uh-huh.
You've got a commitment of 80%. So you got $800K. So you got to fund the delta of 200, right? And then more than likely you're buying something that you're going to want to be able to refinance at some point. So you're going to want to force that appreciation. So for us, we always buy something that's value add. We don't ever buy anything that's already completely done and fully occupied or anything like that. So you're going to need some working capital. Let's just call it $100,000 or 6 months worth of working capital. Then you're also going to need some money to do the renovation. And then you're going to figure out, and part of that renovation is your construction costs, but also all the pretty things, right? You got to design the room, you got to decorate it, you got to put in all your new camera systems and remote door locks and all that. So I would just go ahead and say, if you got $1 million deal, you're probably going to be raising 500. So you got 200 to get it closed, and then another 300 for working capital and renovations.
Correct. And that's furniture design, door locks, like you said, and let's just say floors and paint, or hopefully not a crazy heavy gut rehab, correct? Yeah.
Yeah, and reserves.
Okay. So now that $500,000, I want to talk about the difference between raising debt versus raising equity, right? Because there's, again, going back to the beginning, there's a million ways you can raise a deal. You can offer without having to offer JV. Again, we're talking strictly raising for the money from private investors. The idea is if you raise with debt simply means that you're going to pay a percentage of interest on the money that you're raising.
This is cash on cash return.
Correct. So a $500,000, you offer somebody 15%, you're looking at $75,000 a year.
Yeah.
So it's annualized. So every year you got to pay $75,000 divided by 12. Now, you guys can take this any way you want. You can offer monthly payments on that $75,000. You can offer quarterly payments on that $75,000, or you can offer bi-yearly payments, or you can offer yearly payments.
Yeah, or it can accrue, right? So it can just, whenever you refinance out of it, if it's been 2 years, 3 years, 4 years, 5 years, whatever the case may be, so then they have that.
And one big check.
But yeah.
Yeah, plus the money that they put in.
Yeah.
Right. So that's super important with the debt that you're raising. Now, at the end, that money has to go back. The original $500,000, talking about this $1 million deal still, that $500,000 has to be given back to the investor or investors, plus all the money that they've made in interest over the last 5, 10, whatever years their money was in the deal. So don't forget that part, which is kind of, there's something important to say here. We're using 15% as a starting point. You guys can offer whatever you want, right? There's a lot of investors with different levels of risk that they're willing to take. You can offer as low as 8% and you can offer as high as 20%. You've got to do the math on your deal to make sure that those numbers make sense, because you need to be able to pay that money monthly with the money coming in from the actual deal itself. So if it's a house, if it's a hotel, if it's an apartment complex, the rental revenue needs to be able to cover all of your operating expenses plus the percent.
Right.
And then you either have profit or you don't have profit. A lot of things that we see in these big giant syndication deals, and a syndication just means, again, they're raising capital. You split it between owners and investors. The investors are making the majority of the money because they're getting paid their interest, while the owners are making no money on the syndication deals. They only make the money up front by charging what's called an acquisition fee. Right. So we're not going to get into that. Again, if you guys have questions on this, you guys can shoot us an email. Happy to go to whatever details in this conversation that you guys are asking about. Now, let's flip the coin here and talk about instead of talking about a debt raise on the $500,000, let's talk about the equity raise on the $500,000.
Sure. Yeah. So again, you're going to want to figure out how much of the deal you're wanting to give up, and you also want to figure out who it is you're talking to, right? If you're talking to folks that are doing deals versus folks that are just looking to place capital, you want to figure out who are you trying to talk to get advice from, right? Versus people that you're going to go pitch a deal to and want to take their capital and put it to work. And, obviously the strongest point about a deal is that it's going to be a better return than if they have it, just sitting in a bank or invested in some sort of stocks or bonds. It's not really getting the return that they could with a deal. Now, you mentioned 15%. That is, fairly high. I mean, that's more of like a short-term deal. Hard money lenders are charging somewhere between 11, 12, 13%. And then, depending on what the cash flow is, you might have that availability to go up.
Let me stop you for a second.
Yeah.
Just to clarify too, when Dan says short-term, we're talking like hard money loans or just like short, like 6 to 12 month loans, not 5-year deals.
Right.
5-year deals, you're paying typically what, 10, 8, 10, 12?
Yeah.
12 is even high.
Right.
Okay, sorry, continue.
No, you're good. So if you're going to give up equity in the deal, typically you're going to have a percentage, or a pref, that they'll call it, a preferred return. Again, that's paid however you decide to set that up, and that'll be substantially lower than just a cash-on-cash return. But if you're giving away equity, now they're going to get a percentage of the deal that's paid out however you structure that deal. And again, that's the beauty of commercial real estate. And that's the type of structuring that we do. Everything is up for discussion and negotiable.
Everything is a negotiation.
Ideally, whenever you're doing the raise, everybody would have the same structure as far as payment and percentages and all of that. Like we talked about, one of our hotel deals, we did a raise, brought in $300,000, and I've been paying this guy's been getting paid monthly for 2 years, whereas somebody else put in $300,000 and theirs has been accruing for the last 2 or 3 years. So they'll get paid on the refi, and then I'll get reimbursed on the capital, or our group will get reimbursed on the capital that we've been paying that entire time. So apartment deals are a lot different. What I learned in the last mastermind that I was at was most apartment syndicators are giving up 70% of the deal and a ton of the depreciation. And I met with a guy who was like, why? The most he's ever given up is 20%, and he's typically 10%. And again, it just kind of depends on who's your audience. Who are you raising capital from? You raise it from guys that are looking for cash flow immediately, or you're looking for guys that are just looking to have fun with their money, or just place it into a deal because of the relationship you have. They're not really looking for equity. They're looking for more, just a cash on cash return. So it's just so many different ways. Yeah.
Before we get into that, because you brought up such a good point, which we're actually going through right now, right? Knowing your audience. There's so many things about knowing your audience. In the short-term rental space, knowing your audience is who are you targeting for booking your places. In the raising capital, it's like knowing your audience of how they want to park their money. What are the returns that they're looking for? So what person are you going after? We'll touch on that in a second. But I want to go back just to close off the debt versus equity. The difference here is that debt is very simple. It's a preferred return. You're paying the same interest across the board to all your investors based on the amount of money they give you. So on the $500,000, you pay 10%. It's $50,000 a year, 15%, $75,000, whatever that percent is, it doesn't matter. But on equity, you're giving away an actual piece of a deal. And typically the biggest piece of the deal goes to the investors because they're bringing in the most money. Now, that doesn't mean that's the standard. Don't take this as a standard. It just means that that's standard practice for these giant $10, $15, $20 million deals. On a small deal, you can give away 30% because all you need to raise is 30% of the deal for the down payment and the capital expenditures, right? You can give away something, and I'm giving you guys here just an example. And we're going to do episodes in the future about deals that we've actually done with where we raise capital. Not in this one. We don't want to keep them long. Maybe we'll record a couple more as we're going here. But you can do an 8% preferred, which means you're paying 8% interest, and then you give 2% equity. So now you're doing a mixture of both. So I've done one similar. I've actually done one exactly like that, where we gave 8% preferred, which is 8% interest, right? And for those of you that don't know here, I'm trying to be as clear as possible. Preferred means that whoever gives you money, they get paid before anybody else as an owner gets paid. We'll touch on that in a second as well. So, for example, on the $500,000, let's say you get 5 investors that give you $100,000 each. Each person that gives you $100,000, you give 8% preferred on that $800,000, which means that's $8,000 annualized. So you're paying $8,000 at the end of the year, and then you give them 2% equity. Now, the equity could mean that they're going to get 2% of cash flows or profits monthly, and they're going to get 2% of whatever you sell the deal at or refinance the deal at the end of the 5-year term. So if you sell it, and let's say this $1 million deal is now worth $2 million, they get 2% of $2 million. And they've gotten their $8,000 every year until you sold. Okay, so again, bunch of different ways to do this, but that's a mixture of both. Debt, super clear, you're just paying interest. Equity, you're splitting off a chunk of ownership and you're giving away a piece of ownership, which means they're owed money at the end of the deal. Yeah. Now, something like we absolutely need to say, guys, we are not attorneys. We're not telling you how to raise money. We're not telling you what to offer. Something that we absolutely need to touch on this is if you decide to do a raise for any type of deal, you absolutely need to get an attorney involved. There's a lot of paperwork that has to get involved with how you raise money. SEC gets involved. And you have to know how these deals are structured. There's a 506A and a 506B when you're doing syndications. We're not going to go into that right now. Look them up if you don't know what they're about. But basically, you have to raise it over accredited investors or non-accredited investors. They have to be people that are in your friends, family, or people that you can go out and post on social media. Again, we're not going to get into that now. If you guys want to choose an email, we can do an episode about that in the future. But now I want to touch on the piece that you said about the knowing your target audience.
Well, let's B or C. 506 B or C.
Oh, what did I say?
A and B.
Oh, that's funny. So I have an apartment or a house. The address is 506A and 506B. So it's funny. We have had problems with it this morning, so that's funny.
Well, let's come back to that point. But also, we're talking about the equity portion. So the other part is When you refi, some folks, they'll let the folks that get refi, they get their capital back. Some of the groups offer them to stay in the deal in perpetuity at a lower percentage if it was, just kind of depends on the waterfall structure. Or they get refi, they get their cash back, and then they roll it into another deal or whatever, or they're out. So again, that's all part of how you structure it, and again, figuring out your target audience.
Yep.
And then what your plan is as a group.
So it's funny, you said waterfall, and people are going to be like, what the hell is a waterfall? Guys, there's so many ways to structure these deals. We're trying to keep them clean and simple. I don't even understand waterfall sometimes. The way I structure deals, it's clean. You get a percentage of interest, and you might get a piece of equity, and you just get paid whatever that equity is for the rest of the life of the deal, or once we sell the deal, or once we refinance the deal and the investors are out. You can structure this however you want, okay? If you guys have any questions regarding this, again, email us. I keep saying that. That's a great point. I'm glad you brought that up. About the audience, it's very crucial. Now, all of us have different audiences. A lot of you guys that follow me and listen to me and listen to Dan are involved in short-term rentals in one way or another, in sports in one way or another, want to get into boutique hotels in one way or another. So our audience that we need to raise capital from are people who are looking for cash flow. The investors that are going to give us money need to be not necessarily need to be, but we look for that audience who are looking for people who want a preferred return because we can pay it out of the cash flow, right? We don't want an investor who's looking for long-term equity plays that in 5-10 years, they can take a chunk and double their net worth. So there's two different types of people that you can go after. You can go after people that are looking to grow their net worth, or you're looking for people who are looking for cash flow. Same as if you buy a deal. Are you looking for equity deals or are you looking for cash flow deals? The investors are looking for deals that they're going to get that type of return, right?
Yeah. The other thing is, if you're going to meetups and masterminds, typically I'm not going to come to you and say, hey, I got this hotel deal going. You want to, put a couple $100,000 into? You're like, I got my own deals. I'm going to put my own money in my own deal. But that's also what we've learned is that to be able to grow and expand rapidly is, you don't necessarily want to use all your own money in all your own deals, because that eventually you're going to run out of money and your runway is going to get pretty short, pretty quick. So, but yeah, again, like you said, it's really figuring out who you want to talk to. Mm-hmm. And it's just going to take time and repetition and finding the right groups, that have the audience that you're in. For us, this asset class is more cash flow heavy. So it's also, the other thing is figuring out if it's maybe something that you don't have to give up equity, that you could maybe go to a hard money lender. If you can get the renovation done and get the rooms filled or get the whatever it is you're doing cash flowing and force that appreciation and push that value so quick, like we've been able to do with our hotels. The first one was doing less than 300 a year, and then within the first 12 months, we were already close to 600 in a year. So, and kind of same thing with the last one. They were doing 600 a year. We already did 600 in the first 5 months. So that fits that box. But if you're getting into something that's going to be substantially longer, you really got to be careful. You got to be careful because those hard money lenders or loans, the fees and the renewal fees and the extension fees, it's really, really expensive money, and you really have to have it all teed up and ready to roll.
Yeah, I agree. And it gets so confusing and it can get so intricate. I suggest, start a spreadsheet and start writing these things down and putting them into place so from your projections and your estimates to make sure you can cover all these costs and all these fees. One last thing two last things that we're going to touch on, right, is the acquisitions fee, the management fee that a lot of people don't talk about. These are separate fees. The reason I want to bring this up, actually, let me backtrack a second, guys. The reason I want to bring this up is because talking about preferred returns, a preferred return is the fee that you pay your investors first before any other fee that the owners get paid. So us as owners, we get an acquisitions fee that goes up front on the purchase of the deal. That's our money for finding the deal, making the deal work, having the meetings, getting the contract, all that work that you have to do that has to get put into place to acquire that deal first. That's number one. Number two is a management fee. That's a continuous fee that gets paid for managing the deal, right? We got to pay for cleaners. We got to pay for operations in terms of management software, all that stuff. And then there's the preferred payment fee. That fee goes to the investors. Now, with short-term rentals, it's very different than apartments. I want to make this very clear because we're going through it right now. And
well, there's also the other, you have acquisition fee, and then you have asset management fee on top of the actual property management and operations of the deal. Yes. So, for us, we've been very lean as far as fees go. But those are things that as we, continue to do more deals and figuring out, hey, that it makes sense to have a fee on the front side to kind of get paid to do deals like most of the apartment syndicators do. So,
yeah, the reason why there's an acquisition fee is because the large apartment syndicators aren't making any cash flow. They're making their money up front for putting the deal together, right? And they get all the money, they raise all the money, they make the deal work. But there's no cash flow because it's just set rent. Our deals, cash flow very high because we're doing short-term rentals and hospitality and vacation rentals and boutique hotels. But the order of these fees, the way they get paid is also a negotiation. Now, preferred, if you're going to use the word preferred, it means that their preference, they're number one on the line of fees. In an apartment deal, you pay the pref to your investors before you take any profits first. So let's say on our back to our $1 million deal, it's a small apartment complex. Let's just use this for an example. And we're paying an 8% preferred, or let's do 10% preferred to keep it clean. Let's say we're doing a 10% preferred return. You're going to pay $10,000 a year. That money has to get paid before you take any profits. So if you only made $10,000, let's say you made only $11,000 a year in profit, $10,000 go to your investors, and then you get the $1,000 left over. You take that home. If you only make $9,000 in profit, you as the operator are not making any money, and now you owe $1,000 to your investors that have to get paid. It accrues. So now it just adds on to next year's $10,000. So next year you owe $11,000. The preferred means you pay them first before anything else. Now, in boutique hotels and short-term rentals and vacation rentals and all this other high cash flow and assets, typically it goes after the operations management fees. So, like if you hire a co-host, you're paying 15 or 20%, 25%. It's a similar concept. You need to get paid that management fee in order to make the hotel operate smoothly. The preferred return gets paid after that. Now, a lot of investors aren't going to like that. They're going to want to be paid first. You just have to have a conversation and explain, hey, listen, the reason why we pay the management fee, not the asset management fee, the operations management fee, first is because in order for us to operate this deal, we have to pay cleaners, management software, and that fee goes to cover those costs, plus the work being done. And then all the pref afterwards goes to, all the cash flows afterwards goes to pay your pref. And then whatever's left over gets dispersed between the owners.
Yeah.
So I know it's a lot. Hopefully you guys are keeping up with us and we're not confusing all of you. We're trying to keep these short, but we're also trying to teach and give you as much information as possible. So with that being said, again, talk to your attorney, structure these deals the right way, be fair with your investors, be ethical about the way you raise money, know your audience, and go make a deal happen. Any final thoughts?
Know your partnership too.
Oh, actually, let's not end it. Yes.
No. We can do a whole nother episode on that. But yeah, you need to know your partnership and make sure everybody's goals are aligned, doing it with somebody, and make sure that you guys are overly communicating so that there's a lot of moving parts during this process, and just make sure that everybody is in the loop at the same time. So
I want to touch on that really quick before we get off about the partnerships piece. Yeah. And we'll do a whole episode about it next. But this is important because we're actually, when you guys are doing a deal like this, you don't have to do the deal yourself. You can bring in the right partner for the right thing that's needed. For example, I've came on deals to be the operator. I've gotten a piece of equity because I'm doing the operations. If you need somebody to help you raise capital and you have someone who's really good or has a really large network of people, you can bring them on and they can be a partner and they go and raise the money for you. They get an equity based on the money they raise. So just keep that in mind, guys. We'll keep it short. If you guys have questions about partnerships, we'll do a whole episode for you on that because I've done a ton of different good and really bad partnerships. And we can always do that. But just keep that in mind. Deals don't have to be taken down alone. Partner with the right people. Go to the right network events and get the deal done. With that being said, I think this was a fucking awesome episode.
Yeah.
I think we gave a lot of good info.
I hope so.
I to myself.
It's kind of all over the place, but
yeah, no, this was great.
We'll see.
Hopefully you guys enjoy this, and we'll see you on the next one.